The Great Depression is typically taught as an unavoidable disaster. Standard history accounts frame it as the natural consequence of 1920s excess, the inevitable crash that followed a decade of over-leveraged banks and wild speculation. In 1963, economist Milton Friedman challenged that narrative. He used decades of economic data to argue that the catastrophe was a choice, not an inevitability. Friedman and his colleague Anna Schwartz identified the culprit, the Federal Reserve. They found that specific, identifiable decisions made by the central bank turned a routine recession into the worst economic collapse in modern history. The most influential of those decision-makers was Benjamin Strong, the first governor of the Federal Reserve Bank of New York. Strong was a talented banker who helped build the very institution Congress designed to prevent financial panics. Yet he made a single choice in 1927 that set a global catastrophe into motion. The Great Depression is the record of a specific policy failure and the man who inadvertently triggered it. By 1927, Britain was struggling to maintain the gold standard. High unemployment and uncompetitive exports were draining the country's gold reserves, which were flowing directly into American vaults. Montague Norman, governor of the Bank of England, asked Benjamin Strong for a favor. He wanted the Federal Reserve to lower American interest rates. Lower rates would make the dollar less attractive to investors, stopping the gold drain and giving Britain room to stimulate its own economy. Strong agreed. In July 1927, he cut the discount rate to 3.5%. He dismissed warnings from fellow board members, who argued that cheap credit would fuel dangerous speculation at home. That cheap credit flowed directly into Wall Street. Investors began using borrowed money to buy stocks on margin, creating a market where even a small price dip could wipe out an entire portfolio. Over the next 2 years, the Dow Jones Industrial Average surged by 150%. This growth wasn't driven by industrial value, but by the massive influx of debt Strong had enabled. A well-intentioned international favor had effectively turned the American stock market into a high-leverage time bomb. In October 1928, 12 months before the boom collapsed, Benjamin Strong died of tuberculosis. He was 55 years old. When the market crashed in October 1929, the fallout was immediate. Stock prices plummeted, losing a third of their value in a matter of weeks. Strong's successors then committed a fatal error. Instead of injecting money into the system to stop the panic, they stood by as the money supply contracted by a full third between 1929 and 1933. This contraction created a deflationary spiral. Thousands of banks failed, credit disappeared, and the life savings of millions of Americans were simply wiped out. The institution created to be the economy's fire department failed to act because the only leader who understood how to use its tools was gone. By 1933, the human cost was undeniable. 1 in 4 American workers was unemployed, and the nation's industrial output had collapsed. Through the gold standard, this American deflation spread to every major economy. Countries linked to the dollar were forced to contract, importing the crisis. Germany was hit hardest. By 1932, their unemployment rate reached 30%, and the nation's economic credibility was destroyed. This widespread desperation created the political vacuum that allowed the Nazi Party to rise from a fringe movement to a majority power. One decision in 1927, followed by a vacuum of leadership 3 years later, triggered a chain reaction that reached far beyond the American border. In 2002, future Fed Chairman Ben Bernanke publicly acknowledged this history. He apologized to Milton Friedman, on behalf of the Federal Reserve, for the policy failures that caused the Great Depression. When the 2008 financial crisis began, Bernanke faced a collapsing credit bubble that looked remarkably like the one in 1929. This time, the Federal Reserve followed a different path. Bernanke aggressively expanded the money supply and used emergency lending to prevent the banking system from seizing up. By applying the lessons of the 1930s, the Fed prevented a second Great Depression. The difference was a deliberate choice to provide the liquidity that Strong's successors had withheld. Strong's career serves as a cautionary tale for institutional decision-making, where the global economy's survival can rest on a single person's judgment under pressure.